Well, then, for everyone who has tuned in, so much for joining us for yet another webinar brought to you by the Commercial Committee of Texas Realtors. My name is Mishika Guillory. I'm the chair this year for the committee. And I wanted to again just welcome everyone and tell you thank you for joining on. And we do welcome feedback for topics you want to hear about in the future. With that said, I am done, and we're going to let our committee liaison take over for the day.
Thank you, Mishka, and hello everyone. Welcome to today's webinar. It's the third in the commercial webinar series that we have. As Mishka said, my name is Jed Kleppen. I'm a commercial real estate broker in the Austin area. Some of you might also recognize me as an instructor for some of your CE classes. I'm also serving, as Mishka mentioned, as the 2023 Texas Realtors Commercial Committee Liaison. Today's presenter is Dr. Daniel Oney, the research director at the Texas Real Estate Research Center. As my computer technology issues are always a blast. So the topic of today's webinar is commercial markets, new trends or nothing new. And I managed to completely break my computer here. One quick little item of housekeeping. If you do have any questions during the presentation, please put your questions in the chat window here, and we will try to address as many as we can as we're going through the presentation today with Dr. Oney. Daniel joined the Texas Real Estate Research Center in 2022. He specializes in building forecasting and decision models to help public and private leaders make better economic and fiscal choices. Before joining the center, Daniel was a managing director at Newmark's Global Corporate Services Division, where he supported clients with site selection, labor analysis, and development strategy. Daniel was the economic research manager for the city of Dallas and senior economist for the Virginia General Assembly. He holds an MPA and a PhD degrees from the University of Texas in Dallas. And so without further ado, Dr. Oney, welcome, and I'll turn it over to you.
Okay, well, thank you, Jed, for that introduction. And I also want to thank Mishika for extending the invitation to the Real Estate Center for us to come and spend some time with you today. So that's part of our mission. I mean, we have a dual mandate from the legislature to do real estate research and then to disseminate that. And so we take both parts of that mission seriously. I'm going to start screen sharing. Well, let's go ahead and again, I'm really grateful for the time that we had to spend together today. Let's talk a little bit about what we're going to discuss. And I apologize, this is more of a one-way conversation. I really like being in person with people and having a conversation rather than a lecture. But what I'm going to share with you today is one, I'm going to talk a lot about the macroeconomic drivers that influence commercial real estate asset classes. I'm going to spend a little bit of time giving you my perspective as a former commercial real estate consultant, and that perspective is really, representing the occupier in a lot of their real estate decisions. And I'll elaborate a little bit more on what I did when I was at Newmark and how that informs the way I do commercial real estate research here at the center. The third thing, given the amount of time, I want to balance this. The third one, we'll talk a little bit in more detail about Texas-wide commercial markets, and I'm going to focus on industrial and office for the most part. Those are areas where we've gotten the guidance from some of our advisors to spend most of our time right now, and so I'm going to focus on that. And we'll be getting in deeper on retail and multifamily, really starting next fiscal year in terms of our research. And then the last thing, at the Real Estate Center, we have produced a 2023 commercial, or actually economy-wide forecast. I'm going to share with you some of the predictions that we made on the commercial market for this year. And now we're 5 months into it, so almost at the halfway mark, and we can see where we are and how we did with those forecasts. So I want to take a minute and just make sure everybody is familiar with who we are at the Texas Real Estate Research Center. You can say the acronym is TRERC, which sounds a little bit too much like TREC, the Real Estate Council. But we did go through a rebranding a couple of years ago. We had been using the shorter term, just the Real Estate Center, but we wanted to get back to our roots and remind people that we're about doing research on real estate. We go all the way back to the 1971 Texas legislature, and the Real Estate Center was created by the legislature at the request of the broker community. And again, our mission is to broadly research anything to do with real estate or urban or rural economics, and then to disseminate that research. So you can really drive a bus through a mandate that's that wide. And each of the researchers at the center takes a little bit of a different focus in what they do. Currently, we have 9 members of the research team. I have the privilege of being the research director. Now, I don't guide or tell these other researchers what to do. They have a lot of autonomy in deciding what they think is important and how they want to pursue that research. My role is really to help coordinate, making sure that we're addressing the agenda that our stakeholder community wants us to focus on, and making sure we're managing our resources, our time, our data, and other resources efficiently and effectively. And then personally, the research focus that I bring to the center is focused on commercial assets. As I mentioned, we do have an advisory board that's appointed by the governor. So these are mostly brokers. There is a non-broker member that's added to that board, and they approve our research agenda. So we just went through a meeting with them last month and had our research agenda approved for next fiscal year, which starts in September. We're housed at Texas A&M University, although we have our own enabling legislation. We're in the Division of Academic and Strategic Collaboration. So that's a group at A&M that focuses on outreach. So all kinds of engagement with the community, and it's a good fit for us. Rather than being in an academic department, we're more centralized, and then we have opportunities to work with economists and researchers throughout the school, because there are research programs that are important for real estate in ag economics, in the business school, and in other areas. And then we have 5 big buckets that we tend to focus on. So rural land was our first research area. We have data on rural land sales going back over 40 years that we use. We publicize that, and that's used by that commercial community to do risk analysis and to track trends statewide. And as far as we know, that's a unique data set. Nothing like that exists anywhere else in the country. And we want to lever that and grow that even more. We're going to be expanding to much smaller parcels that are closer into the urban areas where a lot of land transactions are happening now. Of course, probably the biggest piece is residential real estate. We have some other great data sets working with the local realtor boards in the MLS systems. We collect that data, we analyze it, we turn it back to the realtors for their use, and then we use that data to do research, trend analysis, special studies, et cetera. We also spend a lot of time, we have a dedicated research attorney on staff to look at real estate legal issues. If you look at the TG magazine every quarter, there's always a lot of articles in there about legal. That's very practical and important for realtors and their day-to-day work. 4th bucket's commercial, and then the 5th one are special projects that may cut across a lot of areas. So I want to take just a second to talk about how I'm focusing on commercial real estate, because I'm going to have an ask for you a little bit later in the presentation to let directly reach out to me and let me know what's the best way that we can help you in your commercial work. Again, my priority right now as research director is to make sure we have the right data and the right infrastructure to do commercial research. That includes the models, the framework for analyzing all of that, and then turning it into, boiling it down into useful recommendations or guidance for stakeholders, whether they're realtors or occupiers or other groups in Texas. I want to bring a statewide coverage. Now, the big 4 markets get a lot of attention, and certainly most of you are probably in, Dallas, Fort Worth, Houston, Austin, San Antonio, but we've got 25 metropolitan areas in the state. And so whenever I'm doing commercial research, I want to make sure I'm touching on those other markets, and you'll see a little bit of that statewide coverage in this presentation. And I think the best way that we can help is not to just regurgitate data that you might have from a commercial vendor, whether it's Reese or CoStar or other providers. That data is useful, and we do rely on it to give us a framework to work in. But where I think we can add the most value is helping you interpret the economic drivers of commercial real estate. And that's what I'm going to spend most of my time on today, is talking about how economic output, how employment, demographics, finances, et cetera, are impacting these different assets. And then you can use that hopefully in your work to make better decisions, to help your clients to make better choices. I do bring the occupier perspective. So that's who I worked with during my days in commercial real estate. So I worked across all industrial assets and office assets, not as much in retail. That was a different practice group within Newmark. But I spent a lot of time, whether it's automotive, batteries, electric vehicles, semiconductors, aerospace, food, in the industrial area. And then in office, a lot of work with life science, software companies, insurance companies, financial services, and legal for the most part. And then for my personal research agenda, this year I'm focusing on industrial. So I have a little bit more to say about industrial, but we're going to go also into office on this. So just real quick, there's some placeholders in here. Want to give people a chance to ask any questions at this point before I dive into the macroeconomics. Just questions about the center, about me, other sort of housekeeping related questions. And Jed's going to be monitoring those. So Jed, if there's nothing on there, then we'll jump into this.
It's quiet right now. We're good to go. The chat was off earlier, so it should be on. We should be able to submit questions here as we get going. So
great. So we'll start with the biggest possible picture that we can. I do pay attention to what's happening at the global level. You know, we live in a really interesting world. There's a lot of changes going on right now. The bar chart here is a forecast of gross domestic product that's put out by the International Monetary Fund, and they're calling for 2023 for total global economic activity to grow a little less than 3% this year, to grow about 3% next year. And I've given you some details here for what they'd call the advanced countries. So this would be the US, Western Europe, Japan, some others. Much slower growth for us. And then the developing or emerging economies, so this is everyone else. So they're actually predicting the US to only grow about 1.3% this year, maybe 1.4% next year. Supply chains have loosened up a lot for a variety of reasons, but generally the problems that we had over the last 2 years in terms of getting material and goods has eased a great deal. But at the same time, world trade has slowed down a little bit. Consequences of different national trade policies. World Trade Organization, they have a barometer. If it's above 100, then that's growth. Right now, they're below 100. So that's softening a little bit, but yet total exports have been growing recently. So there's some mixed news when it comes to trade. That's the big picture. Output and trade are probably the most important drivers from a global perspective when it influences commercial real estate. Now, to focus back down on the US, I'm going to spend a little bit more time here on gross domestic product or total output. And that's defined as the market value of all the goods and services that are sold in the country. And that's the broadest measure of economic activity that we have. Now, what I'm showing you here, I took the lines out. You typically see a line chart. I took the lines out just to show you the annual data points. But this was GDP growth going all the way back to the Great Depression. And the blue boxes represent where those dots fell. And then the percentages here show what the average was over these different periods in time. So during the Depression, the World War era, we had about 3.7% average growth, but it bounced around a lot. You see it was highly positive, highly negative, up and down, a lot of volatility. Then we went into this sort of golden age of stable economic growth It stayed at 3.7%, but it was very tight, so there was better management of the economy, perhaps just more consistent growth, more consistent policies. And that regime, that era ended, in the mid 80s. And what we saw is long-term growth fell from 3.7% to 3.1%. Again, it didn't change a lot from year to year. We stayed at about that 3% average. And then, since the great financial crisis, the U.S. economy is really sort of lost a little bit of its mojo, maybe. We've only been growing on average about 1.7% each year. So long-term growth has been slowing down, even though the volatility has not been bad. Now, maybe we're going into an era we might have a little more volatility with just dynamics, political dynamics, trade dynamics globally, with challenges we're facing domestically. But the big picture is that the economy has been slowing, and you saw the forecast on that previous slide. It's only for 1.4%. So we're actually entering an era where we're growing slower than we've really grown in almost 100 years. And that's going to be probably the number one driver of commercial real estate. So just keep that in mind as we move forward. So to get a little more recent, this is a chart looking at the compound annual growth rates over 10 years, over 5 years, and over 3 years for the United States and for Texas. So the US is in blue, Texas is in orange. You see that over 10 years, Texas was really outperforming the nation by almost a whole percentage point in terms of its growth. In the last 5 years, we've only been beating the country by about 0.5%. And really in the last 3 years, Texas has been growing at about the same rate as the nation. And that's something we're not usually used to. We're used to growing much faster than the country. And you see over that 10-year period, even as the growth has slowed down, we've grown our economy by 69%, whereas the nation's grown its economy by about 1/3. And why are we not growing as fast? We're not as driven by oil and gas as we used to be, but this is the contribution to growth. So if you add up all the sectors in the economy, which ones are growing, which ones are shrinking, this shows you where that slowing Texas growth rate is coming from. So the mining and oil and gas sector, what happened to that sector has really wiped out 87% of the growth that we would have seen if that sector had not been in relative decline over the last few years. We all know construction's down a little bit because of more recent trends in interest rates. Utilities down a little bit, but where Texas has been continuing to grow, and that's given us our positive growth overall, the professional, scientific, and technical services, here, good job, guys, real estate, rental and leasing, growth in that sector, and then growth in information. So we've seen some service growth offsetting some of these losses in the real economy, so to speak. And then when you compare Texas to the US, if we take our total growth rate by industry and subtract the US growth rate, Texas is growing faster than the nation in the service sectors. So these are management of companies, information, real estate, rental and leasing, finance and insurance, and then transportation and warehousing. We're all doing better than the nation, from 3 to 5% better in each sector. But where Texas is lagging is some things we used to be a real leader in. It's more those real economy sectors. So in agriculture, construction, mining and oil and gas, the nation's actually growing a little faster than us, or it's shrinking at a slower rate than the state of Texas is. Now, I spend so much time talking about GDP because, again, I think that's one of the most important determinants of what happens in the commercial real estate. And when you hear on the news that GDP grew by a certain percentage point, I want you to remember that there's different components to that. You can look at the components the way I just showed you. How is each industry in the economy doing? Or the other way we total it up is that these broader sectors, we all hear that consumers are 2/3 of the economy. That's what this infographic here is representing, is that we can look at all of the economic activity as being either consumption, the stuff that we buy to use, investment, the stuff that we make to make more stuff in the future or to do our work in, trade, which is moving the goods in and out of the country, and then government, which is the last bar. So I've color-coded the components of each of these that are really important for real estate. So within the consumption sector, about 23% of that is on goods. So goods that are being bought and sold and moved around. And that has, of course, a major impact on manufacturing and warehousing, which has an impact on industrial real estate. The investment component, 4% of all of the economy is in non-residential investment. So that's building office buildings, warehouses, everything else that we do work in. And about 3% of total economic activity is residential, so building places for us to live in. And then finally, trade is pretty much all about goods. I left out the trade and services here and to show you that 21% of total GDP recently has been that import-export. Now, it may be negative if we're buying more from abroad than we are selling, but from an industrial and a warehouse standpoint, whether that good is staying here to be shipped out or it's being brought in before it's distributed, it needs to have a warehouse to set in. So trade both ways influences industrial real estate. Overall GDP influences, of course, all of the sectors, which influences office. And then each of these goods components is also basically, it's flowing through some kind of retailer, whether it's an online retailer or a brick and mortar retailer. But each of these components becomes an important contributor to commercial real estate trends. And just in the red inset, I would point out that these components that I've highlighted related to real estate were actually a negative. They were a drag on the overall U.S. economy last year. So if they were all we did in the U.S., our economy would have shrunk by over a percentage point. Other pieces offset that, so we still have this little bit of positive growth. But again, these are headwinds, or these are not really strong drivers from a national real estate perspective. So beyond total economic activity, which we measure with gross domestic product, the other, probably the second most important factor to keep in mind is what's happening in employment. And this is an area where, even though the value of our output may not have been growing so much more than the US, Texas is definitely outgrowing the US when it comes to jobs. So if we look at the absolute percent change over the last 5 years, or if we look at the 5-year annual compound growth rate, we're doing more than double in terms of employment growth compared to the country as a whole. That's being driven by a lot of migration, natural population increase, just a lot of businesses wanting to be in Texas to be near this growing market, and then other businesses that want to be here because they find the operating environment to be better than what they used to face. Another component, you may hear about the JOLTS data. No one really talked about JOLTS until recent years. This data has been around, as you can see, going all the way back to 2000. But it's the job openings and labor turnover. And it's a survey that's done of businesses to ask them, how many people do you intend to hire? How many postings do you have? How many people did you lay off? How many people quit? And you can use that to get a more detailed picture of what's happening in the economy. Now, what I'm showing you here is the rate of job openings. So where it says 1 to 8, that means a 1% job openings. There was 1 job opening for every existing 100 employees. If it's 8, then there were 8 job openings for every existing 100 employees. So you can think of it as a percentage or as a rate. But this shows what the job opening rate was in Texas and the US going all the way back to 2000. You can see the big hump over on the right side, where when we hit COVID in 2020, companies became desperate to find workers. And you saw job opening rates jump up from a historic level of about 4%, almost double. They went up to 7. They went up a little higher in the country than they did in Texas overall. One of the nice things for commercial research use is the JOLTS data nationally is collected by industry. So this chart showing you that same, what was the average job opening rate the 3 years before COVID, and then what's been the average since COVID for the United States as a whole, for Texas as a whole, and then for the major sectors that influence our commercial real estate assets. So manufacturing, transportation, and warehousing for industrial, information, finance, and insurance, real estate rental and leasing, and professional business services for office, and then accommodation and food services and retail for the retail component. So the orange bars being since COVID, every one of them is higher. So demand for workers was up across the board as people withdrew their participation in the labor market. Retail, even as bad as retail was hit, there was still a small increase in job openings for that sector after COVID. And by after COVID, I mean the month that the lockdowns began in March of that year of 2020, going until last month. Okay, the other piece to look at is we saw what companies were hiring. These are the layoffs. And what you see here is pretty much a flat line, about 1.5 layoffs per 100 workers consistently over time, except for a jump up after the financial crisis, and then the major increase to do with shutdowns during COVID. And you saw that the layoff rate decreased as companies were desperately trying to hold on to workers, but it started to edge up again. But we're still below historic levels. So you'll hear talk about lots of layoffs in technology. That's true. But even that industry is not really doing anything extraordinary compared to what we usually see in a normal economy. And there are actually some benefits from some of these layoffs. A lot of the clients I used to work with were desperately seeking tech workers, and all of those were being vacuumed up by the big technology companies. So the mid-sized companies and small companies have had great opportunities to pick up developers, website developers, software engineers, et cetera, because of some of those layoffs. And then I'll show you the same chart looking at layoffs again across these industries before and after COVID. Layoffs did go up a little bit recently. These increases are reflecting in what happened immediately after COVID. But you can see the one sector that really stands out when we heard all the stories about was accommodation and food services. So hotels and restaurants, how they were decimated by loss of business, and they didn't need as many workers, so layoffs jumped quite a bit. They almost doubled. So this is data that you may not track, but I would encourage you, in addition to paying attention to what they say the headline numbers for GDP, look at what's happening underneath it, or listen for what's happening underneath it. Same thing with employment. Pay attention to the industry details, and then take a look at the JOLTS data. You can Google it easily. Just Google that, and there's a nice PDF report, plus some infographics and some interactive tools that are on the Bureau of Labor Statistics website. So you can go and check one of these for yourself, and it's fairly simple. If you deal with a lot of industrial assets, see what's happening in manufacturing, or in transportation and warehousing, or in retail, et cetera. Third big macro statistic for commercial real estate is of course personal income. We've seen pretty steady growth in real per capita income over time, though there have been definite changes in the distribution of this income. We've heard about the decline of the middle class. That has implications for how people spend their money. We really are becoming more of what we call a dumbbell society, where there's more high-end wealth. There's more people that are maybe struggling on the margins. Not as many people in the middle, which is really, really different. We've been a middle-class driven economy for over 100 years. You can see the spikes over on the right side that represent government stimulus during COVID. So those were massive short-term infusions of cash. We saw people's savings rates go up. That's passed. We've seen income fall back down a little bit and beginning to recover in the quarters since COVID. Inflation. This is not a surprise to anybody. I wanted to show you a couple of different measures of inflation that we typically hear news reports about the CPI, the headline inflation for consumers. The most broad measure of that's the blue line. I'm in the chart that you'd see on the left. That's the all urban. So that's an average of everything that people spend their money on. And it's grown, as you can see, from a starting point, if we say 100, 20 years ago, up to 170. though it really gave us that hockey stick almost going straight up in recent years due to supply chain issues, due to the housing components that are within the CPI that really increased. We saw apartment rents and home prices go up. I showed you the all urban without food and energy, so that's sometimes reported because food and energy are volatile. So some economists want to pull those out and just show you the core one. But I mean, on the other hand, if you don't need to drive or eat, you definitely can use that one to plan your budget. But most of us have to include those other things in our daily lives. But construction prices are something that has gone up even faster than the overall CPI. I'm showing you a couple of statistics from the producer price index for the costs of building a warehouse or the costs of building an office building. And these literally did go vertical. If you were trying to build an industrial building 2 years ago, 18 months ago, you were probably looking at maybe a year ahead, 6 months to schedule the purchase of the steel, and you hoped you could get it in that time. It was really difficult to get buildings started because of the shortage in materials. Okay, because of that inflation, we all know that the Federal Reserve had moved from a very, very lax policy. We had very low interest rates since the great financial crisis in the early 2000s. It's been an unnatural period. A lot of people have gotten used to low interest rates. Now we're moving back into an area that was really more normal. Younger people, if you talk to younger people in the industry, they've never really seen high interest rates. People can't believe that at one time, families used to finance mortgages at double-digit interest rates, and they did, and they were able to make those payments. But what's happened really, and this is a 30-year fixed rate chart showing the percentage change month to month in interest rates. It's not that interest rates are necessarily higher now than they have been historically, but since 1971, so going back 50 years, we've not seen interest rates go up this fast before. And it's the rate of change that makes it hard for businesses and for families to manage their finances and to make investment decisions. So 475 basis point increase since March of last year. The targeted Fed funds rate is between 5 and 5.25. Of course, every other interest rate will be a little bit higher than that. Commercial lending has tightened up a lot. The requirements for equity has increased. The willingness to loan has gone down. The amount that the loan to value is not what it was before. And so it's making it harder to do deals, new construction. And then, of course, the big problem that we're seeing in some bank failures and is probably going to continue to be a problem is refinancing all of the commercial debt that's out there right now. The numbers are, 300 to 400 billion to be refinanced this year and about the same amount next year. We're only part of the way through that. So we do expect to see some continued softening in these markets, especially office, because of what we've seen with work from home and the impact of COVID on that. So that's some dire news. Those are some headwinds. A lot of the macro statistics don't look as good as we would like. Thank goodness we do live in Texas and we do benefit from the amazing growth. We've gotten used to growing, adding people. Texas population has grown by 170% since 1970. The nation's only grown by about 2/3. So you can see here, Texas in the orange line in an index consistently outgrowing the country. Part of that growth certainly comes from new people moving here. That's what we typically think about, but it's not always that. Now, what's happened in migration, there was some strong growth in the early 2010s, people moving to Texas from other parts of the country. That slowed down a little bit as we approached the COVID crisis. And then since COVID, like a lot of things, COVID accelerated trends that were already beginning to happen. So the migration to the Sun Belt was already going on. It was going to continue happening, but COVID probably spread that up and gave us about 4 years of growth in 2-year time frame and really changed the trajectory of some of these numbers. So the net domestic migration in Texas last year was almost 250,000 people. So 250,000 more people moved to the state than moved out. and international migration, which was also decreasing in recent years, is back up at its highest level that we've seen in more than a decade. So both of those components adding to growth. Another way to think about it is every day in Texas, almost 500 people move here from somewhere else in the country. From another country, I mean, over 1,000 move here from some other state. We add over 1,000 people every day in Texas, and there are about 700 deaths per day. You stack all those up, that gives you the annual growth and the change in our population. That's for the last, say, from July 1, 2021 to 2022. It's this type of growth, as I like to say, it covers a multitude of sins. So even as we expect the national economy to slow, even go into a recession, I don't think these migration trends are going to change a lot. And just because of this growth, Texas will experience an easier time in coming years, though it may not be pleasant for everybody, but we should certainly be better off than the rest of the country. So I want to stop real quick. We're moving through the time here, but I want to give anyone a chance to ask questions about those macroeconomic drivers and how they influence the different commercial real estate assets.
Yeah, Daniel, we did have one question. Someone asked in regards to the population growth, do you expect that to be leveling off at any point, or what kind of trend are we seeing with that net migration into Texas?
Boy, I really don't see it changing a lot. These stories, these types of trends tend to reinforce themselves. I think they're driven by a few things. Of course, when I first got into economic development real estate, 25 years ago, Texas was super competitive when it came to all sorts of costs. And then, places in the Midwest, the coasts were just more expensive. So we've seen the affordability of Texas go down a little bit. The average multiple, if you look at home price versus income in Texas, it's about 3 to 1 to 4 to 1. It used to be even cheaper, so a home only cost about 3 times what the average income was. But still in California and New York, that multiple is 7 or 8. So the relative savings, even though it's harder to buy a home these days, it's certainly cheaper to do it in Texas. Home prices and income and the tax effect on that are the number one reasons why people make these interstate moves. As long as Texas maintains its current taxing policy, the property taxes we know are at a disadvantage compared to other states, but our overall tax burden for individuals is really competitive. A lot of tech companies, other companies that want to relocate out of places like California to Texas, the leadership of those companies are doing it because they want to benefit from those personal tax differences, and they want their employees to benefit from those as well. So I don't see that trend changing. Of course, it could slow during a recession, but I think we're going to benefit from that for a long time.
And just a quick one more question, kind of dovetailing on that, and you did touch on it here at the end. Do you guys track the migration of corporate headquarters that are moving to Texas beyond just the people?
We don't, and that's something we don't do a whole lot of work in that area. I think we could add that. I'm going to actually segue. My next section is going to talk a little bit more about the relocation process, what I did at Newmark, and some insights I think that might be helpful for people that want to work with commercial clients. So what we saw in my clients, and then what we've seen since COVID, especially, we know about the change in the office market, the work from home, and how that's devastated it. And certainly the neighborhood amenities and the building amenities are so much more important. We like to segment the offices into Class A, B, and C. I think actually the biggest risk right now is going to be in the older Class A spaces. Companies that want to be in Class A space, they do it as part of their brand, part of their image, part of their talent recruitment. And then those are the companies, the higher end, high human capital companies that actually have the lowest in-office occupancy right now. They're doing a lot more work from home. So the best Class A buildings should do well. The older Class A buildings will probably be in trouble and are going to have to retool themselves somehow. But I don't know that they're going to be super attractive for the companies that are in the Class B buildings right now. If you're Class B or C, you're just using space. It's not a part of your image. You're going to be super cost conscious. And so I think the pressure is going to be on those second tier A buildings for a while. And that's what a lot of relocation clients are looking at. So you're still seeing new product coming out in Austin or Houston or in places like Uptown Dallas or the Platinum Corridor, really nice office space that's in demand, whereas some of the older buildings may go looking for clients. And the other interesting thing, relocations used to be a lot about finding cheaper talent, especially technology talent. But because of work from home and what you can do if you're a software developer, for instance, you can work from anywhere, and companies can't really save money anymore by relocating if they're trying to hire software engineers because the wages have become more equal across the country. So that's a disincentive for a tech company to move to Texas for that reason, but they still have the personal tax advantages for leadership and the other people that do relocate. On industrial, we've seen such a boom in the inventory that's been deployed. Used to, you could look at what manufacturing growth was and kind of get an estimate for industrial space. But so much of our industrial inventory that we've added lately has been driven by retail. And then the other thing, the manufacturing space that's been added uses a lot fewer workers per square foot. So we've seen massive investment in things like electric vehicles, batteries, semiconductors. Texas has especially seen a lot of the semiconductor announcements, and you just don't use as many people. You might have had $1 billion investment 10 years ago that 3,000 jobs would come with it. Well, now one of these new projects, these capital intensive projects, $1 billion investment is probably only going to bring a few hundred jobs. And so that changes the way local governments are going to think about economic incentives. They may have to focus more on the tax value and not as much on the job creation. And the other thing is that entry-level wages went up everywhere. I mean, everywhere in the country, we were working all over the place, $5 an hour for starting wages. If you were paying 12 in Mississippi, you went up to 17. If you were paying 20 in Ohio, you went up to 25 just to attract those workers during that time. And again, retail is still trying to figure out what the right mix of space is and how to compete on experiences. And when companies are doing these moves, a company will think about new space for a variety of reasons. Of course, they want to save money if possible. They may want to, it may be a talent play to improve their attractiveness, to keep people or attract talent. A lot of companies want to move to reinvent themselves. It's easier to pick up and move somewhere else and potentially rebrand yourselves. So as commercial brokers or people that serve commercial clients, it's important to make sure you really understand. I know going after the deal, renegotiating the lease, or maybe finding another space somewhere is what you're driven by, is that transaction. But to always be mindful of the trade-offs and the value you can add by helping your client think about what is the impact on their talent. If they move to another location, have you done the commutation analysis that says, yeah, this actually makes your office easier to get to? Or if you move there, it's going to be harder to get to. Are they thinking about the neighborhood, what the amenities are? Again, other things to attract their workers. Of course, if somebody's moving across the country or across the state, it's a whole new level of analysis. And it's not just the costs, but it's a lot of those other factors. So there's that trade-off. I know any analysis, anything you do to slow it down, puts you further away from that commission, but just keep some of those things in mind and how it might help you to be sticky with that client or to cross-sell other services down the road. Now, this is the kind of framework that companies are typically dealing with when they're relocating. They're going to be deciding between market conditions, which are about talent, operating environment, and the quality of place, versus the savings. And so you can plot these, and this is literally what relocation consultants do. They'll plot these companies or these markets and say, okay, if you move all the way to the right and all the way to the top, those are the best markets. They have the best conditions, the best talent at the biggest savings. And then there's markets all the way on the bottom left, which cost you more money and they don't have as good a talent or work environment. But usually there's a trade-off. So in this example, You could do something like from Houston, it may be the best of both worlds, but if you want to be a little bit more about talent, maybe Raleigh for your market has a few more people. So you'd trade off some costs for that. Or maybe you want to go to Louisville because you're more cost sensitive. You're going to give up some of the talent benefits in exchange for costs. So those are the things that clients tend to think about when they're doing, especially a relocation from a California or New York or Illinois to Texas. Not every Texas market makes sense. Some will make sense to some companies, and then some won't. And, you know, for better or worse, we don't win every one of these deals, but this is what the process looks like. And when it comes to incentives, those typically are tiebreakers. Most companies that are serious about a relocation, they're doing it for one of those major reasons that they think their company needs to do it to survive or to become a better company. And what the incentives do is become tiebreakers. Now, I promise you, companies and site selectors will bid states off against each other, and they will bid communities off against each other. But it's yet to be seen what communities are going to do about incentives going forward. So I have a lot of data in here about Texas industrial and office markets, and it's stuff that you can view as well on your own. I'm not going to spend a lot of time to go into the details. You can see that in your slides, but in some of the time we have left, I'll just give you a big picture view. So what does commercial real estate look like in Texas? It's, you know, over 5 billion square feet of inventory. Industrial is the largest share of that. And you can see the big four are certainly important, but the 21 smaller markets account for more industrial real estate than all of Austin and all of San Antonio combined. So that's one of the reasons why I want to give those smaller markets some attention and make sure we're covering statewide. When it comes to office, the bigger markets dominate a little bit more, but the smaller 21 metro areas still account for more than either Austin or San Antonio by themselves. And when it comes to retail, that's even more important for smaller communities. They're 25% of the total retail inventory in Texas. And of course, they're bigger than the number 3 and the number 4 markets. So I'll stop real quick if there's any other questions about site selection, relocation, or anything I've said so far. And then I'm going to move ahead to our economic outlook for the rest of the year and next year.
Pretty quiet in the chat right now on questions. I think you're doing a good job answering a lot of questions that come up as you go through. So
okay, we'll take that charitable interpretation, and not that people have gone to make a sandwich or fallen asleep. So okay, so this entire forecast you can find on the Real Estate Center's website. It's our 2023 outlook. We talked about some major issues, of course, that we think will influence the forecast. These are upside or downside risks. The way China was at the time, they were resisting opening, but since they've opened, and I put some italics in here, those are how I kind of modified these on my own. This was a team consensus forecast, so anything I say here that's different from what's in the original document, it's all on me. Of course, monetary policy is tighter. We've talked about that. I wanted to emphasize that we've got a divided Congress, and now we're certainly hearing talk about debt ceilings and other impasses that'll have a major impact on commercial real estate. It's not a political statement. It's just you've got two parties that are sharing power, and people don't always agree. And then inflation, and what happens to inflation and job growth will be a big factor. So on industrial, we've actually done a pretty good job on this forecast so far. We've seen deliveries fall. We've seen credit impact that. And then we've seen, as we thought, vacancies have ticked up just a little bit, but rent growth on industrial is still positive in Texas. So it's still a super strong asset for this state. And I would continue to see it to moderate. But I think the tightening, because of no new product coming online or not as much product over the next couple of years, is going to make demand for this sector even bigger, say 2025, 2026. I've already told you a little bit about my view on the office sector, that I think we're going to see more segmentation in Class A buildings. I think Class B buildings could also lose. I said could see a free fall in occupancy. I think that's overstated now with what we've seen so far. Class C space tends to be well occupied. But the older properties, we're going to see some challenges as banks start talking to these loan holders. There's going to have to be some decisions made, some haircuts, cutting value. If the rent rolls won't support that loan payment, then the prices of these buildings are going to come down. Now, in office, we could see a wave of conversions to residential in downtown areas. That would be a real positive sign. But as some of the research that my colleagues have done recently, that you have to get those buildings pretty cheap to make the residential conversion pencil. And I think rental rates, we will see some softness in there, especially in those second tier Class A buildings. And then finally on retail, I'm actually pretty bullish about retail. I do believe that I said that people would be coming back to the malls. People wanted to get out after COVID. We've seen brick and mortar take a hit because of the rapid growth in online sales during COVID. It accelerated again, that trend. But since then, it's slowed down. Brick and mortars pull back. We've all heard about Amazon giving up options on space or slowing its investment. And the brick and mortar stores are doing a little bit better. Texas is actually a little under retailed compared to the nation. Now we're still probably over retailed. We have about 50 to 60 square feet of retail per person compared to more like 82 square feet per person nationally. So we're maybe not as much of a risk of an overhang there. But I think over time, you'll see older centers, portions of them repurposed to residential. The mix of tenants, we've seen that change with things like fitness centers and of course other health uses going into retail. And again, I don't think the malls are dead. I think the malls still have a vital role. You'll see some of the older 70s, 80s era malls retooled into new mixed use developments, and the really nice high-end malls will continue to chug along, catering to that market. So one of the last things I want to do is, if you have your phone, you can actually pull up this QR code and answer a couple of questions. We've been doing some statewide research with all of our audiences. It'll ask you about your expectations in terms of overall economic growth, job growth. This would be, say, within the commercial area. And then what do you think is going to happen with taxes and regulations? So you can do that. I'll give you a second while that's happening. The other ask that I would make, I do have my email in here. Let us know how we can help you do a better job with your commercial clients. If there's certain sectors or areas or certain trends that you want us to pay attention to, we can certainly try to build that into our research agenda. So please, you can just email me directly. Be happy to have a conversation with you if it made sense. And this survey will last for indefinitely. So if you don't do it now, when you get the PDF version of this, you can pull this up and add your voice to it. The other kind of fun thing is that we do include the results. So once you've taken the survey, you can snap this QR code and see what the results were from this call.
And Dr. Oney, one question while everyone's
I'll go back to the first one. There we go. Go ahead.
Working on those. With the outlook, the financial outlook, do you think increase in the national debt will cause a slowdown or even a crash nationally? And how would that also affect Texas as well then? Right.
Yeah. So, I think we're going to see we're going to see more debt. It's the structure that we've set up in this country. That's one of the mixed blessings of a democracy is you have a lot of people competing for what they want the government to do. And of course, all these interest groups get their programs supported by supporting each other. It's called log rolling, right? So we live in a society where government just tends to grow over time. So unless we can get economic growth back up, remember when we were growing at almost 4% back in that golden era after World War II? If we were growing that fast, it wouldn't be as much of a problem. But when we're only growing a little above 1%, we don't have the wealth to support that much debt. Now, fortunately, consumers are not as in a bad a condition as they were back before the financial crisis. It's these commercial loans that are maybe going to be the big problem going forward. If the country were to fail to make its interest payments, we talk about the debt ceiling. If we were to fail to reach agreement on that, then that would have an impact on other countries and people's willingness to buy U.S. treasuries and support that government debt. And then you could become in a really serious inflationary crisis, where loss of confidence in the dollar means that we all end up having to pay a lot more for everything that we buy and sell, and that would have a definite drain on the economy. So, I'm hopeful that the politicians will work it out, but that's always a risk.
Thanks for that. One last one we'll sneak in here. Someone asked, what are your short and long-term views or forecast on the office conversion to residential or other uses?
We're seeing a lot more of it than I thought we would. Texas cities are actually leading in this area. We've got some really good developers here that are willing to take risks, but it's the funders. You need to get the money for it. If you can't get the building at a really low basis, it makes it hard. What I think we'll see for some of the bigger buildings is the approach that's happened recently of, it's not to convert the entire building to residential, but you keep a mix of uses in the building. You keep some office because there's still some demand for office, but then you think about hotel or other uses in addition to some residential. So I think we're going to see an acceleration of it, at least in the next few years, as more of these office buildings don't make sense as office buildings, or at least as pure office buildings.
All right. Well, Daniel, on behalf of the Texas Realtors Commercial Committee leadership and all the attendees here, thank you for taking the time to talk with us today and for sharing your knowledge and insight here on the markets.
Oh, no, I'm grateful for the opportunity. Thanks for your time. And as I said, please feel free to reach out to me directly and let me know how we can do a better job in covering the commercial landscape for all of you, because you're our stakeholders. That's why we're here, and that's why we do it. So hope everyone can have a great rest of the day.
Thank you, Daniel. And to everyone else, in the next few days, we'll be sending out a PDF copy of the presentation. We'll also be uploading a recording of today's webinar to the Texas Realtors YouTube channel. So make sure you subscribe and hit that bell to get notified when new videos are available. Finally, mark your calendars for July 26th. That'll be the next commercial webinar. As we get closer to that date, we will open up the registration for the webinar. So keep an eye on the commercial page and the commercial specialty section on texasrealestate.com for the registration links for that webinar. And thank you all once again for joining us today, and we hope you have a great rest of your day.